So, when somebody is buying a home, what is one of the things that they should be thinking about when they're choosing to get life insurance? Because that often comes up.
Well, first is, how much of a loan that they're taking out.
Okay.
They wanna make sure they cover the loan, of course,
All right.
but there's other things they wanna consider as well, but that would be the first thing.
All right. Well, that's a great start. And we're going to learn more about this on the Loan Doctor podcast. I'm Rich Brandt, the loan doctor with the Brandt Lending Team. And I've got Dwayne Merchant here, my guest, my friend, my insurance advisor, who is with Northwestern Mutual. He's a certified financial planner with over 300 years of experience in the insurance industry. No, really, he's only got 20 years plus experience. He's not quite that old. So, Dwayne, welcome. Welcome to the podcast.
Appreciate being here.
So tell me, how did you get into life insurance?
Oh, wow, that's a long story somewhat, but, I started out in the investment side of the business,
Okay.
uh, 20 plus years ago, and, um, and then just transferred over to the insurance side because it was, I think, more of a calling for me, protecting families. I've been through the dot-com crash. I've been through the real estate market crash. I saw what it's very difficult managing portfolios on the investment side, but, the insurance side is more conservative. Um, it seems like more of my clients are my friends, and my father passed away at a relatively young age. I was, 19, he
Okay.
was 47, and, if it wasn't for life insurance, I might not be talking to you. You're sitting here today. I mean, it helped my mom pay for my college at
Well,
Florida State University, kept the bills paid, paid off the mortgage
okay.
for the home, and made things, obviously more manageable.
Okay. What do you think people misunderstand most about life insurance?
That it is only a death benefit.
Oh, okay. How do you mean? So
So there's different types of life insurance. There's term insurance, which is what typically most people will own at some point. And there's permanent life insurance, which can be used more than a death benefit. It's basically a tool, a financial planning tool, um, in your quiver with a number of other tools that are used.
okay. All right. And I know that one of the things that I see a lot with insurance, especially with what you do, is it seems like, younger people or people don't seem to talk about insurance until they need insurance, which is often, that'll lead into a different question I have for you too. But why is it that you think, what do you find what's the apprehension that keeps people from talking about insurance and thinking about insurance before they actually need it?
Well, I guess no one really likes to talk about the downside of it, right? I mean, you avoid the nastiness, if you will, I guess. The Grim Reaper aspect of it.
Right.
And that's just not life insurance. That's pretty much any insurance.
Mhm.
But I think the big difference between a lot of the other insurances and financial lines of insurance, which is what we're talking about here today, and what I do,
Okay.
um, other types of insurance, most of the time, I think all of the time, are required by law, one or by another entity for one reason or the other.
Okay. You're
And
talking
what
about like auto
I'm talking
insurance,
about auto insurance, you can't
home
drive your car
insurance,
without it, homeowners insurance, you're
yeah,
not gonna be able to
mortgage.
get a mortgage,
Right.
right? Open a business,
Yeah.
you're gonna have to have liability insurance that
Sure.
when you
Sure.
go to well, for the studio here, for Cole, when he signed a lease, I'm sure they said, "Where's your liability policy?"
Right.
You gotta have one. So, those insurance are typically required, whereas life insurance, disability insurance, long-term care, those financial lines, they're not typically required, so it takes someone like myself, a planner, to sit down with someone and point out the holes that they have in their overall financial plan, and that's typically why it's not brought up.
What are some of the things that you do?
Plus, it's just boring, but anyway.
Right. What are some of the things that you do to get people to talk about insurance and to not kind of focus on that Grim Reaper aspect, but like you said, kind of financial planning and to a certain extent, even wealth building?
Well, I mean, I think one doesn't go without the other at the
Okay.
end of the day.
Mm.
when you're talking to someone about financial planning. And that you bring up an interesting point because as a financial advisor and a financial planner, being on both sides of the fence, the proverbial investment side and then the planning side. And I know a lot of investment individuals out there that call themselves planners, but they're really not a planner. They're just managing your portfolio. And that's all they do. Because a real financial plan doesn't exist without insurance. You know, doesn't without life insurance or income protection, if you will. If you don't have that, then it's just a gamble. It's not really a plan.
And this is something that you kinda touched on that I brought up, but and it's something that I know about other companies in terms of, like, your client base and stuff like that. When you're managing a portfolio and including their insurance and stuff like that, how many typical clients are you working with at a time?
What do you mean?
Well, I guess, like, there are companies out there, I don't wanna say any specific names, but
Okay.
there are some companies out there where you go and you meet with a financial planner, and you meet with an insurance person, an insurance advisor, and you're one of 1,500 people that they're representing at any one moment in time. And generally, what I find with you is I get a lot of personal attention myself, so I can't imagine that you're dealing with 1,500 people a month, and I'm just wondering, when somebody chooses to go to you as opposed to one of those investment houses and stuff like that, how much more personal attention can they expect to get? Because you simply put, you guys, have less clients
Mhm.
so that you can give better service.
Yeah, I mean, I think most advisors, I think we strive to get to that point where you want to be the ultimate service person for your client. I mean, at the
Mhm.
end of the day, I mean, but yes, I kind of model myself over being very hands on. All my clients have my cell phone. They call me directly. Um,
Sometimes at 10 o'clock at night.
yeah, sometimes, yeah. Or my clients could, they'll never won't go into that story, but um, yeah, I mean, it's just normal for me for that level of service. I mean, I'm actually working on a transfer right now, ironically, for a 401(k) that I manage, and the lady, she's older, she retired, and I offered obviously to help with the rollover transfer, and she was going to go to another institution,
Okay,
one of those it rhymes with guard,
okay.
and she just wasn't getting the service that she was older, needed the hand holding, and they told her to go to the bookkeeper. Bookkeeper told her to go to an advisor, and I said I can't help with external firms. I said I can help roll it over here, and she's like, let's do that. After about a month, she called me back. I can't get anywhere, and I'm in the process of doing. We're in my team, myself, are in the process of rolling over to doing all the paperwork, making all the calls, doing everything. Which I'm surprised that that's the difference between full service and like a discount, institution, if you will.
Sure. I do want to say, speaking for me, I was actually having this conversation with my mother the other day. My 401k outperformed my mother's 401k by over 6% last year. And you were the one who set up my 401k for what my allocations are.
Nice,
So
nice. Well, I don't know if we want to put that on the podcast actually, because I'm not really supposed to be helping you with your oops, okay, 401(k) because I'm not the advisor on that plan. So I didn't really do that. So I don't know what you're talking about. Is this a cell phone? Crank call, crank call.
so yeah, we're gonna edit that part out.
Yeah.
Nobody's gonna know.
we-
I was just making it up.
Yeah, it was just hypothetically. Yeah.
Hypothetically, if you had given
Well,
me the
what
stuff,
happened is
it would have
I
been the
said,
reason.
these are some good funds.
Yeah,
Hypothetically, these are some good funds. And
hypothetically.
hypothetically, this is the allocation you probably should be in. But yeah,
Hypothetically,
hypothetically. Correct.
hypothetically, right, had that happened,
Correct.
I would have outperformed my mother by exactly a little over 6%.
Correct.
Alright, that's good to know.
All right.
So, tell me, when is the best time, and we touched on it a little bit earlier, when's the best time for somebody to get life insurance?
As early as possible.
Okay. So even at 20, I'm gonna live for another 60 years, hopefully, it doesn't matter,
At
as early as possible.
at 1.
At one, no, absolutely.
So right out of the womb.
Tell me about that. So I do know about something like guaranteed benefit or something with life insurance where if you get it before you turn 18, if you were to have a disqualifier, you would automatically be accepted. Do you know what I'm talking about?
So what you're alluding to,
Yeah.
not the right terminology,
Yeah.
is something called additional purchase benefit,
Okay.
which gives the insured the ability to increase their insurance when they turn 18. With Northwestern Mutual, it's 22. With Gerber, it's at 18. I
Okay.
know they have you ever heard of the Gerber plan?
You're right. Yeah.
I think it's you get a
Mhm.
$100,000 policy, and then at 18 it automatically doubles to two. Ours is very similar. Ours is has options of increasing from 100 or 200, but most of my clients, they have, their grandkids or they're just their kids will take out a $100,000 whole life policy. I mean, you could do more,
Mhm.
but that's the typically average.
Right.
But with that policy, you can have the ability to purchase another $1.4 million worth of life insurance for that child, starting at age 22 up to age 40 with no medical underwriting.
Got it. Okay.
So basically, what they're doing is they're locking in their health status as a 1 year old.
Okay.
So we know what can happen over time. I mean, a lot of different things. I mean, this day
Sure.
and age with kids. I mean, anxiety, depression, obesity, diabetes, all those things can come in. But if you've taken out a policy early and locked in their insurability, they're gonna be able to get insurance at the health status of a 1 year old versus, you know, what they're probably gonna get the health status of a 70-year-old if they're not in good health, if they have
Got
some
it.
of those
Okay.
issues we just spoke about.
All right. So if you're 1 years old and you're listening to this podcast, I want you to call Dwayne to get that insurance so you have that guaranteed issue.
I mean, shoot, the nowadays that they're giving cell phones away so early to their kids, I don't there might be one out there with one, I don't know.
I'm waiting for the iPhone to come out with the first fetus phone,
Yes, correct, correct.
right?
No, don't endorse that at all.
Uh,
A whole nother subject, but, not a big fan.
yeah, no, too much internet, too much internet. So this is kind of a trick question. So tell me, who doesn't need life insurance?
Who doesn't need life insurance? Gosh, I'm biased.
Yeah, right,
Everybody need life insurance.
right.
I
That's
mean, everybody does.
yeah.
I guess I could make a case. I'm trying to think, you know, if someone really has no heirs or beneficiaries,
Okay.
no significant other, they're a widower, uh, they don't wanna pass a legacy to anybody in terms of, a charity, a nephew, a niece,
Right.
you can make a case there, right? But even if you're extremely wealthy or, we were having the sports talks earlier, you're a Mark Cuban or some of these billionaires, they need insurance, right? They have lots of insurance, most likely. Um, and if you're lower income, you need insurance, take care of your family. If you are middle class, I mean, for life insurance, you could make a case for that teenager or so that's not working, doesn't have any, but they're still burial expenses.
Right.
And we still spoke about locking in that insurability for them,
Sure, sure.
you know. So there's instances, but not a lot.
Okay. And what
Just
about
maybe about the amount.
I know I said specifically life insurance, but life insurance is also there's disability insurance, there's long-term care.
Correct. And the
What
financial lines, correct.
right.
I mean, the life insurance and disability, we call that income protection at the end of the day.
Okay.
So, disability is life insurance is if you don't make it home from the podcast, right?
Right.
You hit by the proverbial bus. Disability is if you get hit by the proverbial bus and you do make it home,
Right.
but you have no way of bringing in, an income, a salary, and that protects your income in that case. And it's probably more important than life insurance. It's a higher claim status than life insurance. And
What
being
does that mean, a higher claim
we
status?
have, the claims are higher for disability.
Okay.
Like, we have more claims on disability waiver on the life insurance than on life insurance in general. And the disability waiver is just something that if you get disabled, you can't work, Northwestern Mutual or any carrier will pay the premiums while you're disabled,
Oh,
as
gotcha.
long as you're disabled for 3 or 6 months, depending on the policy.
Mhm.
Um, But in the real estate industry, I think most foreclosures are attributed to a medical, but it's mainly bankruptcies and foreclosures are medical, but it's because they can't work,
Right.
couldn't pay their bills.
Right, right, right.
But then those didn't have disability insurance or income protection, most likely.
It's funny just because you bring the mortgage thing up, and that's exactly right, is that most of those are that interruption in income that cause those, you know and the funny thing about the interruption in income is a lot of times you might have an interruption in income, and what ends up happening is it gets you so far behind that even though it might not impact you in that year, it impacts you 3 or 4 years later because you were never able to catch up, and now you've got credit card debt, and that's compounded and everything like that.
Absolutely, and part of that,
Mm.
catch up is, a lot of planners will miss is those years you're not contributing to your retirement plan, your 401k,
Right.
right? So let's say if you're disabled for 2 or 3 years, it's 3 years that you missed saving for retirement that you've gotta catch up on. So that's
Yep.
part of it as well. So, but if you did have an income coming in, you can still fund those retirement accounts.
Right. What are some of the things that happen to a family financially that doesn't have life insurance? And then we talked a little bit about bankruptcy, foreclosure potentially.
I mean, there's millions of guys different scenarios. Oh, nice. All right.
Yeah, nice. I think you're getting a call.
All right.
If you need to get that, I mean, we're only doing a show.
It gives me a number of different it really depends on the scenario, but a lot of times it's, they're gonna end up selling first thing is selling the home
Right.
that they lived in, right? They're gonna have
Yeah.
to downsize most likely,
Yeah.
if they can't pay the mortgage. That's the first step, using and living off some of that equity. Spouses have to go to work,
Yeah.
typically to stay on the spouse. Maybe
Yeah,
get a second
expenses.
job, to send the kids to work,
Uh,
drop out of school, help the family. My roommate in college um, well, not my roommate, but my roommate's roommate, the one that I took his spot, he dropped out to go help run his father's business because his father passed away.
like you kinda said earlier when you mentioned about your dad passing, when you were young, if he didn't have insurance, you might not have gone to school, you might not have.
Correct. My mom used the money, paid off the mortgage for the home. So I stayed in that house. We stayed in that house for, I mean, I think she sold it when I was like 26, 27. But I think she sold it to get me out of the house, get us, fixed, it was great living at home, it was, um, but then I bought a villa then but I think it was
Okay.
forced on me. I think,
No, no,
but
no.
anyway, other, but yeah, there's a myriad of scenarios if they don't have proper protection.
When I went to high school in Israel for a semester, my mom moved while I was in Israel for school and didn't give me the address that she was at. So when I landed at home, I wasn't sure if she was coming.
Nice. All right. It wasn't
They
that
they
bad.
didn't have cell phones the way we do today.
But, yeah, so I was able to stay in the home and be able
Yeah.
to go to school, so, very important, of
Alright.
course.
Now, what role does life insurance play in protecting the home? And not just life insurance, but disability insurance, long-term care, all those kind of protections. Having insurance protection, how does that what role does that play in protecting a house?
I think we spoke about a lot of those scenarios, right? Making sure they can
Mhm.
keep the house, maintain the house, right? God forbid something happens, and that's both insurances, life or disability. So, yeah, I mean, I think we discussed a lot of those. It's really just being able to keep it mainly,
Yeah,
maintain it.
sure.
There's a lot of expenses in, maintaining a home.
Now, do you put together a different strategy for somebody who owns a home as opposed to somebody who's renting?
Yes, I would say it can. It really comes down, I mean, it really depends on what their goal is. So if they're usually if someone's renting, they have a goal to buy a home,
Mhm.
right? So sometimes the plan may be putting some money aside for, that typical goal. Someone that owns a home, their goals may be a little different. They've kind of passed that milestone, so maybe their next step is they're trying to save for education for a child or starting putting money away for retirement. So, yeah, the plan can be different. Yeah, for sure. Budget factor is always going to be a major,
Okay.
criteria, but it just depends on what their goals are. And most of the time, someone that rents, one of the first things they speak about, or one of my goals is to buy a home.
Right. We want everybody who rents to buy a home.
Yes, all right,
Right, and get a loan with the loan doctor.
correct.
Um, is there a rule of thumb for aligning life insurance with like a mortgage balance? So if I owe 500,000 on my home, do I want to make sure that I have at least that amount of coverage, or how does that number, that adequate amount of life insurance, how do you come up with that number?
So, I mean, there's a number of ways that you can come up with the insurance amount, right? They use 10, 12 times earnings, right? Is a typical, if someone makes 100,000, they should have a hundred, million, million two, million five policy. Uh, you can do income need analysis where, which is basically you pay off all the debts, including the mortgage, credit cards, student loans, any of those type of things you may be responsible for. And then you do a spousal income need analysis, which is just using future value, present value tables.
Okay.
Someone, let's say if your spouse, do they plan to stay home, or they going to go to work, or are they going to work part-time? They going to work full-time? How much additional income they need and how long they need it. So let's say $85,000 a month for the next 20 years, and I don't have one in front of me, but it's going to be $3, $4 million policy. You want to pay off the debts. That's one of the goals, but it shouldn't be, the litmus test.
So you want to have the debts because you're going to accumulate more debts as you continue to live.
Hopefully not.
No, but I mean, there's a cost to exist, right?
Yes, I mean, you're gonna have expenses that you have to be paid, or you're going to, incur debt.
So you want to make sure that you're cut those future
I
expenses.
mean, I do get referrals or calls, and hey, listen, I just bought a mortgage, just bought a home mortgage, just 750. I want to get a $750,000 policy, and I'll bring it up, say, hey, what else? Do you have any other debts? No, not really. Do you want some other? Do you want to be able to send your kids to college, or and I'll ask those questions. And sometimes they'll just say, no, I just want 750.
What are some of the differences between like like a life insurance policy that's going to pay off your home and that like mortgage, credit protection insurance that people get?
So, but like I said earlier, they used to have a solution. I don't know of any carriers that really write it, called decreasing term insurance. So, as your mortgage balance decreased, right, the benefit amount of the insurance policy would go down accordingly.
Right, which is why I don't like it.
Yeah. So I just think that, with the cost of those versus just getting a level premium policy and keeping the difference,
Right.
that's where the industry's gone. You don't really see any of those. You don't even see any in other issues. You don't see surviving or dual spouse term policies.
Okay.
Right? Yeah, you have whole life survivorship, whole life, but you used to have those second to die. That's the term, second to die term policies. They don't really write those anymore.
Survivorship whole life.
Survivorship whole life is when this second spouse passes away, then the policy pays.
Oh,
It's usually used for estate planning.
got it. Okay. Okay.
But the second to die for like a mortgage, you run into issues where, what if they get a divorce?
Right.
So who handles the policy? It was great for the advisor because they probably got to write two separate policies, although they can bring those back. No, it's just,
Yeah, right, right. That's funny. And so explain the difference between a term policy and a whole life policy.
so the easy analogy, since we're talking about, mortgages, real estate,
Yeah.
I always like to use with people, to make it very layman, is term insurance is like renting a home.
Okay.
It covers a need, puts a roof over your head. Um, but after you move out, how many years later, let's say you move out 10, 15, 20 years later, how much equity do you have?
Nothing.
You have zero,
Right.
right? Whole life insurance or permanent coverage is more like owning a home, because 20 or 30 years later, you'll have a policy that you built equity that you may own outright. And it's an asset that you can use for whatever purpose, not just retirement, but investment purposes. You pull money out of it and, buy a second property. Real estate investors use it quite often. So that's the easiest explanation without getting too much into the uses.
So I know that for me, one of the things that I always think about a term policy is a term policy is the insurance agent's bet that you're gonna live longer than the policy exists. Is
I
that
don't know for the agent, but maybe the carrier's bet.
No, the carrier. Yeah, I don't even. Yeah, yeah. I don't even the person. I mean, the carrier's bet. No, no, no. Listen,
well, I know at 19 years, you're looking at the guy and say, is he sick? Should I take him out?
Yeah. No, but I don't know the exact numbers. They do share these at Northwestern Mutual. But they're not listening. The majority of our death claims are full life insurance. It's whole life.
Okay, that's a politically way to correct.
Yes,
So
it's not term insurance.
I got it.
That part, it's very small percentage. It happens, right? That's why you got to have it.
No, no, no. Yeah,
But that's why it's super cheap, relative.
well, correct, right.
To versus whole life insurance, and that's where, most of the time when I give people, the whole life introduction,
Uh-huh.
I get a lot of times I'll get, why doesn't everybody own that? And I'll be like, yeah, I don't understand.
Now,
But really, the big difference is just the premium.
do you ever sort of balance a little bit of both sometimes? Like, I'm just kind of thinking, and again, you know more than me, but I'm thinking if I have a mortgage, right, that I'm only going to have for 30 years, is there a 30-year term policy?
Yes.
Okay. So if I have a mortgage that I'm going to have for 30 years and I get a 30-year term policy just for the mortgage and then a different policy to cover everything else. That way, if I don't have the more, if I outlive and I pay off the mortgage anyway, well, then it's okay.
Yeah, I mean, another solution would be
A better solution.
a better solution,
Got it.
possibly.
Okay.
So 30-year term policies are good. There's nothing wrong with them, especially when you get them, super young. You're someone taking out their insurance in their 20s.
Good.
I just feel like when I see those when you're in your mid 30s or mid 40s, the premium does jump quite a bit from a 20-year to a 30-year. And the other strategy is, own a 20-year term. By the time the 20 years, you're going to have built up more assets, right?
Right.
Your equity, built equity, and convert some of that term insurance to whole life. So you have a little bit of both, right?
Okay.
So let's say you have $1 million and you convert 250,000.
How does that process work?
So you typically, with most carriers, there is a conversion feature built in to term insurance. Not
Okay.
all of them, but usually in the first 10 years of a policy, you can convert it to permanent or whole life insurance just by signing a paper. You don't need to do any medical underwriting or anything of that caliber. So at the end of that 20-year period, you could have, even though the rest of that term may expired, you could have a whole life policy that has grown from 250, maybe now it's worth 300,000. It's got 50, 60,000 in accumulated cash value.
Okay.
So that may be enough to cover your finances because 20 years later, hopefully you're in better financial shape. The
Gotcha.
need may be a lot less. And
Okay.
so that's another way than just getting a straight 30-year term that's all renting and, you're not getting any of that money back.
Got it. Got it. That makes a lot of sense. That makes a lot of sense. Now, tell me, now I work with a lot of people who are self-employed. It's a big niche. What are the types of insurance that are there for people who are self-employed, people who might have a partner, a business partner? What are the types of insurance that you recommend for people like that?
The similar tools, the similar type of policies. I mean, it would be term insurance and whole life, depending on, what their needs or goals are. I mean, whole life for business owners is a great tool. The advantages are whole life insurance in Florida are liability protected.
Mhm.
So it's treated as like a retirement account
Okay.
for your home. So if you, God forbid, you got sued, right? Um, and it also can protect your family, but build up an accumulated cash value. Got to make sure I get the technical term correct.
Sure.
That they can use in retirement. So a lot of times they don't have access to retirement accounts that can, successful business owners I'm talking about that can put away money places that are efficient. I
Okay.
mean, anybody can open an IRA and they could put $7,000 into it, right?
Right.
So business owner could do that. They could open up a SEP if
Right.
they're a sole business owner and they could put 25% of their income. That's capped out.
Right.
But a lot of times, these business owners, even if they're making $500,000, they're paying themselves a salary, a W-2 of 100,000.
Right.
So that means they could put 25,000 into a SEP, right?
Right.
Round numbers. So they can put $25,000 away into a retirement account, essentially. Now, if they have employees, they could do a 401k, but they're, in simple IRAs, but then they got to put money away for those employees. That's an additional cost. But if they're looking for another place that they can put money for themselves, that's tax efficient, asset protected,
Doesn't have a cap.
doesn't have a cap, that's where you can use whole life insurance.
Okay.
And if you're just sitting in front of a computer on your phone and you Google the term rich man's Roth IRA,
Yeah.
you'll probably see that pop up.
Okay. Now
It's not an IRA, just saying.
we talk about like we've also talked before about like key man insurance.
Correct. Key man is important for business owners. I mean, it's not just business owners. They can be the key person, or partners, but it could be, your top sales guy, someone that's, I've got some friends that have a business. They do extremely well, and their right-hand person is really, you know, the operations manager. I
Okay.
mean, if something happened to her, I think they'd all be up that paddle without a creek,
Okay.
So, they have, insurance on her, to make sure things run smoothly. But yeah, key man for replacing a key employee,
Okay.
vice president, a board member, owner, partner.
We didn't really talk about annuities all that much. But how does an annuity play into that financial plan?
So annuities are an excellent tool, and it's interesting you bring up some of these solutions. There's been some recent research, by some large companies you're probably familiar with. One of them is the evil empire, I call it, BlackRock. Right? They
Okay.
did
Yeah.
put out a research paper regarding whole life insurance and annuities. There was one a few years ago by Ernst and Young, incorporating whole life and annuities into your financial plan. And annuities are a great tool because it's income that but what I think, well, let me step back. Annuities are a great tool. There's a little bit of, what is that, lack of a phrase here, term, not misinformation, but a confusion on
Oh,
what an annuity or versus an annuitization.
okay. We were gonna get to that.
Oh, were we?
Yeah,
Okay.
absolutely. But
So,
go ahead.
all
You're,
right.
you're on a roll.
Annuities are a great tool. Yeah. So they basically can provide income stream that you can't outlive. Very similar to your pension or your social security.
Okay.
So I do use variable annuities for clients, both qualified and non-qualified. We have, and I know a lot of people have
What
the
does
problem.
what do these terms mean? So like dumb it down
Yeah,
for
sorry. So variable annuity is an annuity that it uses separate accounts. Got to use the terms correctly, and invests in mutual funds
Okay.
that invest in the market.
Okay.
That's a variable annuity.
And
So there is stock
fixed
market
annuity?
exposure and stock market risk.
Okay. And a fixed annuity?
Fixed annuity is a specific term
Got
or a
it.
specific rate that you get. It's fixed for the
Okay.
life of that annuity. You can get 2, 3, 5, 10, whatever.
But generally the riskier one is gonna pay a little bit more
Correct.
if
There's more
it's
opportunity
okay.
is to have growth using
Got
the
it.
stock market,
Okay.
and you can have variable annuities or you can have fixed annuities.
Okay.
And I'd use the variable for clients to get that growth exposure, but also when they are retirement, they can actually, they can access the money, of course, but they could take a portion of that and turn it into a income annuity. It's the third annuity, which is annuitization, which provides them an income stream for the rest of their life.
Similar to like a pension and all that kind of
Correct.
stuff.
Similar to a pet. You're building it a lot. And I use it a lot for my business owners, for that, IRA or those SEPs, because it's a way that they can build themselves a pension.
Does an annuity would in terms of like the benefit, I know with pensions, right, they have a surviving spouse benefit and all that kind of stuff.
Yep.
Do these type of annuities, income annuities, have this also where the benefit decreases if you want it to continue through the surviving spouse?
Yes. So,
Okay.
whenever you take so you have a fixed annuity or you can have a variable annuity, and then you could take either one of those and turn it into an income annuity,
Got it.
right?
Okay.
When you
It doesn't it's not
It's
automatic,
not
turn it
automatic.
to income.
Not automatic.
What happens to the money if you don't turn it into an
Well, you'll have a benefit. It'll go to your beneficiaries if you pass away.
Oh, gotcha. So so if you're decreasing the balance, if you're taking the money.
So that's where a lot of the misinformation comes. So the annuitization is when you actually turn the annuity into an income stream, right? You turn the variable or the fixed annuity into an income stream. When you do that, you will make a choice. They'll get, what your option is. You can make it single life, joint life. You can, and obviously joint life is going to be less of an income stream. You could make it joint life and the spouse gets 75%. So that'll make it a little higher than, just straight joint life.
Got it.
You could do straight life, 10 years minimum, right? God forbid. Because once you annuitize, that's where people hear annuity and they think, oh, I don't want to put my money in annuity. I'm never getting it back. If you annuitize, once you pass away, that portion that you annuitized is gone, unless you chose one of those survivor options.
Got it. Okay. Can you out and you can't ever outlive the benefit.
No,
So
not when you annuitize it. It's based on when you annuitize the income stream, whether it's a fixed or variable, it's based on how old you are, really, and where interest rates are at that time.
okay.
So the older you are and the higher rates are, you're going to get a better income stream versus versus much younger
Okay.
and lower interest rates because it's based on the return and how long your
And,
mortality table is.
and when typically can you withdraw money from an annuity?
Yes, you can
Yeah.
withdraw money from an
At
annuity
what age?
based on certain terms.
Okay.
So,
Not an age.
if you take money out of your annuity before you're 59 and a half,
Yep.
you will see some penalties
Got
from
it.
the IRS, the typical, because it is considered insurance.
Right.
And if you put into an annuity, it's considered, I guess it's not really considered a retirement account. It's non-qualified, but it can be, we're getting way into weeds.
Yeah, yeah. Right.
wanna-
Wait, wait, wait. You know,
Ask that question again.
no, no, that's okay.
Yeah.
We're gonna there are a lot of terms
Yeah.
and things that you talk about and say and that are not familiar to people.
Yeah.
And the one thing that I would do is I would encourage you, and Dwayne's number is going to appear on below in order to contact him. But if you have any questions or if you heard a term that you're not familiar with, and I know I have, um, reach out because there are ways for you to get those kind of answers from a qualified professional. So tell me, how does somebody's coverage change over time?
Well, well, it depends on what their needs are, right? So as people make more money, they
Mhm.
might need more insurance. Um, as they pay off debts and pay off their home, they might need less insurance. So it really depends on, their financial situation, more than anything else, I would think.
How often would you recommend reviewing with your clients to make sure that they are in the right plan for them based on wherever they're at in their life?
Every year, once a year. I mean, we
At least.
strive to,
Okay.
at least once a year. Whether it can be just a quick phone call. It doesn't necessarily have to be a full blown sit down, go through everything. If there's been significant changes, you just want to make sure you talk about those changes. Birth of a child, got married.
Oh, that actually leads me to my next question. What are some of the life events that trigger a review?
Like we just mentioned, obviously having children,
Right.
getting married,
Mhm.
getting divorced,
Yeah.
buying or selling property or a home.
Okay.
The big one is a job change.
Oh, yeah.
You want to review your benefits at the new job,
Hmm.
or maybe opened a business. Maybe you left your, W-2 salaried benefited job and you went on, opened a business.
Yeah.
And, you don't have those benefits that you had before. You take those for granted a little bit, and you need to replace those.
How can better planning create stronger and safer homeowners?
Well, I mean, we touched on a lot of that. I
Yeah.
mean, at the end of the day, right? Making sure that all those, chinks in the armor or those financial holes that could come back to haunt you, are covered. That we've filled those and make sure that you've got no cracks. You have a strong foundation. That's really, and that's what planning's all about. I mean, making sure that, and that's really what insurance is all about. I mean, having the strong foundation that you're going to build your financial plan on. You don't want to build it on a sandy lot. You want to
Right.
build it on concrete, and that's a strong finance. That usually with a good solid insurance plan.
So, for somebody looking for insurance for a mortgage or anything like that, What is it that they should be looking for in a professional? You know, what's the value proposition that the good insurance agents are gonna have, like you?
The value proposition
Yeah.
that we're really going to do what's in your best interest.
Mhm.
I'm a certified financial planner. I'm a fiduciary when it comes to, dealing with my clients. I mean, I think you read about that. You want to deal with a fiduciary when you're dealing with your financial,
Mhm.
you know, assets. So to make sure that they're by law, doing what's in your best interest.
Okay. What do you think one of the some of the biggest myths are about insurance?
We touched on that a little bit. Not just a death benefit.
Right.
Um, but I think one of the big myths is that it's expensive.
Mhm.
I mean, I think we hear some ads on the radio. I mean, those are hyperbole. I mean, I don't know. I was looking for a better word. That those are, a lot of fluff,
Right.
but it's not expensive for a term policy, and there's nothing wrong with owning a term policy. I own term insurance.
Right.
So
Mhm.
and I own whole life, but there's nothing wrong because the most important thing is to cover the need first,
Right.
right? And if you have $1 million need, and if you can afford to own whole life insurance, $1 million, then great.
Got
There's
it.
nothing wrong with doing that.
Right.
Most people can't.
Mhm.
So, you'll own term insurance and then and filter in some whole life with that.
What's been you've been doing this for a long time, lots of experience and stuff like that, and I'm sure that you've had situations where people, thank God, people have gone to you. What's been like, can you think of like an emotional moment that you were just like, thank God these people did like what I said?
Yeah, I mean, so it's funny. I mean, there's a business that I'm really good friends with. I basically handle a lot of insurance for a lot of the employees there.
Okay.
And I think, this is early in my career that you just got to bang on doors, right? So, and I really took it upon myself and knocking on doors and sat down with a number of people that didn't have insurance and said, "Hey, listen, I need, yeah, you know what? You're right. I need insurance." Now, fortunately, they're all still with us.
Right.
However, they've had some serious medical episodes
Right.
since, heart transplants,
Wow.
cancer, a lot of things that are going on. Um,
What's this company too? Asbestos?
I sincerely feel I'm gonna say, I don't know. A good question, but they're all, thank goodness their families are covered if,
Right.
God forbid something does happen to them.
That's awesome. That's awesome.
So I was thinking the flip side of that when you're asking me, you know, the good stories. Do you want to? I mean, there's some bad,
Yeah.
as well. I
Yeah.
mean, anybody that doesn't have insurance, they think they're healthy, get with someone,
Yeah.
get some coverage. I mean, I have those scenarios where I've banged on doors and, people have said, "Nah, I'm good. I'm good." You know, and some of those people are not here anymore. The couple of them I could name firsthand, and it's sad, uh, because, their families they're struggling, you know, and some of those people were very young, you know,
Yeah. Yeah.
during COVID, um, some aneurysms, some of those type of things, strokes.
Yeah, I think we've all known people in our life whose life have significantly changed because a tragedy happened in their family and they
Yeah, it's
didn't
unfortunate.
and they weren't protected. And that's the whole thing is that what you're trying to do is to make sure that somebody isn't so some that doesn't change, right? The whole idea is how do we maintain the same life that you have um
And
in
that's the
amidst the tragedy?
and that's where I do my tagline, the lifestyle protector.
Yeah,
That's really what it is. You're protecting
right,
the
right.
lifestyle.
No,
And yeah, I mean, and I think everybody listening, everybody knows someone
yeah,
that, wow, that family had a major scenario.
right.
And you wonder sometimes, are they, everybody, I think everybody asks their spouse or their other person, do you think they had insurance? Do you think
Oh,
how are
yeah.
they doing? You know,
So,
so if you're asking that question, making sure that you're covered.
right.
Make sure you got all the holes
I
plugged.
I got you. It's funny because it just made me think of something out of the blue, but the loan doctor saves loans
Yeah,
and you save lifestyles.
correct.
just came up with that, like,
Yeah,
on my
just made
own.
that up. Excellent. That's
Like
great.
like
So I have a lot of business owners as clients. I mean, as we know, they like to pay the least amount of tax possible. So when it comes to paying a mortgage or getting a mortgage, their income can show a lot less. I hope the IRS is not listening to what they really probably earn. I mean, they're not doing anything illegal. They're just taking advantage of the tax
I'm
code.
I'm I'm gonna say it a little different because I think I understand what your question
Okay.
is. One of the things that happens with people who are self-employed is their taxable income doesn't necessarily reflect what they could afford in terms of home ownership. Okay.
Agreed.
So, I'm a big believer in the IRS deserves every penny that they should get, that they're entitled to.
You have room
And
for
I
those
and,
homes.
and I think everybody should be happily sending them the money to the IRS that they should be. The only thing I ask is that the government has to spend the money wisely. When they figure that out,
Well,
maybe
that's
people
true.
will be happier to
That'll be
pay.
the next episode.
Yeah, maybe people will be happier to pay more taxes. But
Yeah.
no, I think that what happens is, right, people take advantage of the tax benefits that the United States has, and it isn't necessarily a reflection of your affordability. And so one of the things that I do because I work with a lot of self-employed people, I'm able to sort of figure out what that is and get to that number instead of the number that the tax return says.
Okay.
So we're able to help people to qualify who on paper, like the way you described, they could afford a bigger house or a better house or a more expensive house than what the conventional thinking might support, and we're able to get them the house that way.
What is a first-time home buyer? Like my daughter's, obviously,
Yeah.
she's sending you some paperwork, I think now, or we're waiting on it. I'm in charge of the tax returns. I'll have those to you by
Okay.
the end of the day or tomorrow, I think. But
Perfect.
what is a first-time home buyer? And what is the benefits that they have access to?
So, you know what? I'm gonna say this because that's really a great question. So a first-time home buyer, in terms of like a legal definition, is anybody who has not owned a home in the previous 3 years. So somebody who owned a home 10 years ago would still essentially be considered a first-time home buyer if they were buying and they hadn't owned a home in 3 years. Now,
Oh, that's good.
that's
Okay.
not a home that you haven't lived in, so if you own investment property, you own a home. It doesn't matter that you're not living there,
It's got to
right?
be you haven't owned.
You haven't owned real estate in the last 3 years.
Okay, that's one of those
Now
information.
now, here's the thing that I've said this before about down payment assistance programs. So, as a first-time home buyer, there are programs that are designed to help you to acquire a house. There's a couple different types of payment programs. Most of the programs that are real good, or actually, let me say it like this. Here's the thing that people don't realize about first-time homebuyer programs. First-time homebuyer programs, people believe that they're giving you money, that you're getting something for free. That's the general idea is, "I want a first-time homebuyer program because I'm getting something for free." I'm gonna say nothing's really for free. And what I say is what I tell people all the time, first-time homebuyer programs are great for people who need them, right? If it's the difference between you buying a house and not buying a house,
Okay.
they're not great for people who would just like to have them
It's just
because you're
they're not giving you money. It's just you're paying a lower down payment, essentially.
well, correct, right.
You need to put up front.
You're
So you're
getting
gonna have a higher payment.
value. You are getting something, right? You're getting value, but you're getting value, but you're not necessarily getting as much value as you think, right? So with some down payment assistance programs, what ends up happening is we give you a grant. Let's say we give you $5,000, but now and you've got this $5,000 that you don't have to pay back. But the interest rate on the first mortgage, because we don't control that, is a little bit higher. So what ends up happening is over time, you're actually paying that $5,000 back. You just don't think about it.
I see.
You know, it's the analogy I use that often people um, that people are a little bit more familiar with You could buy a car with 0% interest, right? Sounds great. Oh my God, 0% interest. It's fantastic. Well, if you went to the dealer and said, I don't want the 0% interest deal, they actually sell you the car for less month.
Correct.
Right. In some cases, so much less that if you actually got a loan with interest, you would pay less interest than the amount of money that they saved you on the car. Right.
Yeah.
So there's a perception of value without actual real value. And so that's why I say for people who need it, if it's the difference between you buying the home because you don't have that down payment,
Yes.
yeah, they're great.
Well, I mean, listen, we're sitting in a booth here in at studio area, Boca Raton.
Yeah.
I don't know if anybody's familiar with the average starter home here in Boca Raton, where
Right.
it's a $500,000.
Right.
So the typical 20%, plus closing costs, you need $110,000, to get into a home.
Well, you don't have to be a first-time home buyer to buy a home with 3.5% or 5% down. And the other thing I was going to say too about those first-time homebuyer programs, the best first-time homebuyer programs are not only first-time homebuyers but also low to like income driven as well. The better programs are designed for people to low to moderate income. If you're making $500,000 a year and you're buying your first home, I mean, right? You don't really need it.
No.
You're not going to really get any value taking advantage.
I think it's really for the person that that has 50,000 put down, and versus the extra 50 to.
Absolutely. Young people hot in their first house and has exact again, they're great for people who need it. Fantastic for people who need it. They're not great for people who would just like to have it.
Hey guys,
Oh yeah.
you had mentioned to me, I think a while ago, some benefits are for first responders or a teacher. Yeah. Is there any programs there that?
There are Florida specifically has something called the Hometown Hero program, which is great. Gives you up to 5%. It's actually a very, very good program. They got good income limits too, which is kind of nice. And right now they currently have money available. So if you're a first time home buyer and you're in that field as a first responder, a teacher, in the medical profession, we'd love to help you turn your owning a home into a reality.
Okay, interesting. Okay, good. I appreciate that. There's a couple of questions.
No, thank you for asking me questions. That's awesome. I often don't get questions here on the Loan Doctor podcast.
And so you need to, my daughter, obviously she's working with you right now, and you are the best. And you reach out to her. She's the one that's dialed in with, that a lot of her friends are teachers.
Oh yeah.
So
Yeah, no, absolutely.
see if we can work that out.
All right, perfect. Well, I appreciate you being here.
All right. I appreciate being there. I appreciate you having me.